Hi, Dave Armstrong with Monument Wealth Management. Some of you may know me because I write a blog over the weekend, and normally what I do is I get my thoughts together on some bullet points. And I'm sitting here writing these bullet points out, staring at this new camera that I have on top of my computer. I thought, why not just try to do an impromptu video and talk through my points and see how it's received by people as the video medium versus actually writing some of this stuff out. So I'll just I got my bullet points here. I'm just going to walk through them. So here are three thoughts I have kind of going into the weekend, the things I want to look at in more depth this weekend. One is that really interesting, the stock market's doing really well. Dow closed above 27,000 for the first time, and the S&P 500 was like this close to making it to 3,000. And that's really good. That's really great news. Both of those essentially making new all-time highs. But here's one of the things that I want to be in tune to is something called recency bias in behavioral finance or human tendency world. Everybody feels really great about the stock market doing really well this year, and you start to hear questions, or you may even be somebody who asks this question to yourself, which is, hey, when the markets run up this much, are we due for a pullback? How much farther can it go? Very common question, very common behavioral sort of response to a great market run up that we've seen year to date. But the reality of it is the levels where we are right now in the stock market are roughly equal to where the levels were in January of 2018. So kind of make sure that you're putting things into perspective when you start hearing things about stock market at an all-time high and some of the emotional responses to that, because the picture between January of 2018 to now is kind of the same as for the year to date. So there's a little bit of flatness there, just to put things into perspective. Okay, second thing I'm thinking about right now is, okay, Fed cutting rates. All right, I mean, for real, stock market's at an all-time high. Can they really be cutting rates when the market's at an all-time high? So came across a really interesting research report. I'm going to dig into it a little bit more over the weekend. But LPL Financial put out a research piece that said, hey, going back to 1980, the Fed has actually cut rates 17 times when the S&P has been within 2% of an all-time high. I mean, wow. Okay, I didn't even know that. That's a pretty good piece of information there. So what's also interesting about that is that when they did cut those rates within 2% of an all-time high, the 12 months after those rate cuts, all 17 times has seen the stock market higher. Also really interesting. So just keep that in perspective too. Okay, finally, here's my, in the world of blah, blah, blah with economic data, stuff like that. I have been trying to get away from writing more about that because people just glaze over. I can't help myself sometimes. So here's one little tidbit, is that producer price index for June came out, and it's definitely showing some evidence that there's some inflationary pressure picking up in the U.S. economy, especially, which is interesting because we've had a tepid couple months here, past few months. But slowing inflation has been a concern not only for investors and for anybody involved in the market, but also for the Fed as well. So the fact that their prices are picking up is actually a good thing, and especially amid slipping global demand, which we've seen as trade tensions have risen higher. So those are my thoughts. Just kind of reading some notes here. Going to fire this out, unedited version, and I'd really love some feedback if you think this is a great medium for me to be doing in addition to my blogs.